OneFootball has tens of millions of active users checking scores every single day. Now, they are pushing that massive audience directly into Web3. The hook for this transition is an upcoming token generation event scheduled for the second quarter of 2026, featuring a heavily promoted airdrop. If you look around social media right now, you will see influencer predictions projecting the OFC token will launch somewhere between 30 and 50 cents. While social media projects a 50-cent launch, the CoinList private sale priced OFC at 5 cents, valuing the project at $50 million. This firm baseline leaves a dilemma. Is grinding daily app tasks actually worth your effort? An airdrop is never truly free money. It is a direct transaction. You are paying the developers with your daily attention, your personal data, and by exposing your crypto wallet to very real security threats. To handle millions of football fans, OneFootball is building this infrastructure on the base network, which is designed to process a high volume of transactions with very low fees. The reward system uses a points metric called balls. You must log in daily, complete football challenges, and refer your friends. All those points act as a massive leaderboard. Where you rank directly determines your final cut of the airdrop. The total supply of OFC is capped at exactly 1 billion tokens. When you combine a fixed 1 billion token supply with a massive mainstream user base, the math here guarantees heavy dilution. The slice of the pie available to any single user is strictly limited. Farming this airdrop requires a strict daily commitment. You are trading your time to complete repetitive in-app tasks and generate engagement on their social media channels. There are also hidden microcapital costs. For example, claiming the registration badge on-chain requires you to pay roughly $1 in network gas fees. This pie chart breaks down the tokenomics, which reserve 51% of the total supply for community rewards. While 51% sounds generous, dividing that allocation across a global audience of active football fans means individual payouts become microscopic. We are already seeing friction in this process. Active users are currently reporting deleted points balances and inconsistent leaderboard rankings, making the required effort feel even more unpredictable. You also have to factor in the competition. Human users are mathematically competing against automated farming bots that operate 24 hours a day, further diluting the available reward pool. When you calculate the massive dilution against the strict daily time requirement, the actual hourly wage for grinding out this airdrop will likely amount to a few pennies per hour. The alternative to grinding is the capital investment route, bypassing the daily tasks entirely and buying OFC directly through the initial CoinList sale or later on secondary markets. This line graph shows the token release schedule. Exactly 25% of the private sale tokens unlock immediately at the token generation event. This creates an immediate sell the news event. Private buyers will dump a portion of their newly unlocked tokens. They do this to secure their initial investment and lock in zero-risk profits. This structural sell pressure makes those optimistic 30 to 50 cent price predictions highly improbable in the short term. The market simply has to absorb too much new supply all at once. After that initial dump, the remaining 75% unlocks linearly over the next 12 months, creating a persistent year-long headwind. Buying the token directly saves you time, but it requires precise market execution. If you buy blindly on launch day, you risk becoming exit liquidity for the early private investors. There is a darker reality to these mainstream Web3 launches. They act as massive magnets for sophisticated, automated phishing networks. Threat intelligence already shows active, malicious lookalike domains targeting this specific launch, using URLs like claimonefootballclub.live and billionsnetwork.app. These sites rely on a technical exploit called a malicious smart contract approval. When you click what looks like a harmless claim airdrop button, you are actually signing a hidden transaction that grants hackers unlimited permission to instantly drain your entire wallet. This diagram illustrates the true risk-to-reward ratio. You are risking your entire existing crypto portfolio just to claim a minor airdrop payout. Cybersecurity is the single largest negative ROI risk in this ecosystem. One wrong click turns a $20 airdrop into a catastrophic total financial loss. This graphic maps out your optimal strategy. The right move depends entirely on your available time, capital, and technical literacy. The first profile is the hardcore football fan, who already uses the OneFootball app daily to check scores. If you fit this profile, you should participate, but you must use an isolated burner wallet holding absolutely no other assets, which mathematically eliminates your security risk. The second profile is the speculative optimizer, someone with capital to deploy but very limited time. Speculators should skip the daily tasks entirely, let the 25% token generation event dump happen, and look for post-launch entry points when the FanPass version 2 roadmap rolls out. The third profile is the Web3 novice, a user who does not fully understand how smart contract permissions work. If you are a novice, ignore this airdrop entirely. The asymmetrical risk of losing your funds to an active phishing campaign is simply not worth the few dollars you might earn. In the Web3 economy, there is no such thing as free value. Every token costs time, capital, or risk. Your only job is to deliberately choose which currency you are willing to spend.